All right. Well, welcome back to the iWealth podcast. I'm here with Mr. Brad Connors, and today we're going to talk about a little myth that I heard the other day, that the stock market is way too risky or volatile to handle somebody's retirement. And I guess, how would you respond to something like that?
Yeah, I guess it depends, which maybe gets said here too often, Matt, but when it comes to the stock market and retirement,
Yep.
I haven't had anyone in 25 years that have, came in and we've taken all their money out of the stock market and put it in bonds and cash, and then they retired for 40 years.
Sure.
You have to have some money invested.
Yeah.
But saying it's too risky is basically saying it's too high. We were at Dow 10,000 and 20,000. Now we're at Dow 30,000, and it's too high. I can't put my retirement money in because it's going back to Dow 20,000. And that's people's mentality. And the problem is Sir John Templeton said the four most dangerous words in investing is it's different this time. And so to consider this being a different time because we hit a new high is wrong. So I guess the bottom line is it's not too risky, but however, depending on how long you need it. So if you can, live through a cycle, if we go into another recession and the market goes down or whatever, you've got to be able to have some cash to retire on. But you also cannot afford to just have it all out of the market either. So does that make some sense?
It does make some sense.
Yeah, it really depends on where you're at in life. If you were 2 years out from retirement, it should not all be in the stock market. But to say it's too risky in order to put your money away, where else are you going to go and get 4 or 5 or 6% rate of return long term? Yeah. Because right now you're just not getting it in the banks, not their fault, and you're not going to get it in bonds necessarily either.
Yeah, so. I like what you're saying there. I guess for me personally, and again, this is just me personally, but that rule about every 7 year, there's never been a 7-year period, right, that you didn't make some amount of money on your money in the history of the stock market. And there's some comfort in that for me personally. Yeah,
and it depends on what markets you look at, whether it's the S&P 500 or the Russell 3000 or whatever those are. But yeah, if you can stick in the market and get through cycles. I mean, so put it this way, we've never not hit another all-time high. Yeah. Right? So remember, Dow 10,000's coming, we're too high, and then we hit the Dow 20. Now we're at Dow 30. Matt, there'll be a Dow 40,000 someday. Yeah. Will we be here to see it? Will we have the money in the right spots, when that happens? So that's the same strategy I use as the market goes from Dow 32 today to all of a sudden Dow 25, and people think it's going back to 10. Yeah. Of saying, listen, we're going to be back. You just have to be able to stomach and ride that piece out. So you got to have your money in different buckets, but it's not too risky to be putting your money aside.
And isn't there some saying about it's going to go up and down like a roller coaster, but that's also why you get on the roller coaster? Yeah, because it goes up and down.
I have not heard that.
Isn't that kind of a fun?
I haven't heard it, but you look at some stock market charts and you'll definitely see that. But it's always on an uphill climb. Yep. It just depends on where you're buying on that uphill climb, and when you need the money. If you don't need the money, you can stomach and you can let it ride out. But you just need to make sure you're diversified.
So circling back to the retirement question, the answer is, even if you're playing conservative, it's still okay to be using it.
Yes. Cool. Yep. Final answer.
There we go. All right. We'll see you soon.
Yep.